Hey there, everyone. Welcome to Chart This with Dave Keller. It is Wednesday, December 18th. I'm your host, Dave Keller, coming to you from a rainy and quite windy Redmond, Washington. I don't know anything going on today. Kind of normal day, right? Nothing much to report. There are times doing a daily market recap show, which I've done now for a number of years. There are times when to be honest, you're kind of scrambling, looking for things to talk about, trying to pick out some interesting charts and thinking, all right, what can I do to sort of make this interesting? This is the opposite, right? A day like this is when your cup runneth over with things to talk about, charts to show. And instead of scrambling to find a couple things that could be interesting, which to be honest with you, I mean, there's usually some interesting stuff to review. I don't have to try that hard, but boy, a day like today, half an hour or so does not feel like nearly enough time to try to make sense of what we all just observed. So here's the story, right? If you've been following my work for a while, which I know many of you have, and I appreciate it so much, we've been talking a lot about concerning signs that have been building. If you ask me whether I'm surprised as to what happened today, I am not. And I've had a number of people talk about, ask questions about things like the Hindenburg omen and breadth deterioration and all these things. And what you have to remember is some of those things are timing tools, right? A MACD buy signal is like a moment where something happens and it suggests you take action. Other things like breadth deterioration or divergences or sentiment shifts and things like that are not necessarily timing tools, but they certainly describe how a market is changing. And one of the things that we, mentioned so many times is just having a good situational awareness, a good market awareness. And hopefully you've been seeing some of these signs and it's just we've been setting up so perfectly for a day like today where, as we mentioned, all eyes on the conversation after the Fed announcement, and that's certainly when things started to deteriorate very quickly. I mean, there's an initial pullback at 2 p.m. With the Fed announcement, but the real acceleration came after 2:30 p.m., which is when comments sort of very strong, I would say implied but almost guaranteed, don't get too excited about rate cuts because there aren't that many more coming. And that, of course, has caused the market to be shocked to the downside. I think if you're surprised by the surprise, that's where the issue is, because I think we've been seeing sort of signs building here for a little while. Having said that, let's try to make sense of this. And it's so funny. I think just yesterday or earlier this week, I was talking about the sorry, I'm sharing my screen now. This is what the market carpet looks like today. We've shared this image many times, and this is the reddest I would say it has been in quite some time. The good news is some of these charts are still fine, right? From a long-term perspective, not much has changed on a lot of charts, but the short-term environment certainly feels different. And I'm sure you picked up on that after 2:30 p.m. This is the risk for a market during a rate cut cycle, because at some point, the market sort of always prices in that rates are going to just keep getting cut and that the free money party is just going to continue forever until it doesn't, right? And any implication that the music might be turned off here at some point, the market clearly taking that as a bit of a negative. All right, enough of an intro. Let's look at the damage, try to review and reflect on what's happened today, and as always, try to make sense of it and look forward. I mean, the good news is overall, I mean, while this was certainly a big down day and certainly one of the biggest down days we've seen in 2024 by far, the S&P, surprisingly, still above our line in the sand, right? Our line in the sand wasn't even triggered. We did push below the 50-day moving average, but the line in the sand is still holding. For us, that was 58.50. And as I mentioned, anything above 58.50 is kind of noise, and that's why we sort of do it. I'm sure you would have felt very good if you didn't sell yesterday, if you'd cashed out yesterday and were just watching the red and being thrilled you weren't a part of it. But if you still own a lot of stocks, which I certainly do, remember, you have to separate the short term from the long term. A lot of the long term charts are still fine, right? Apple's still a pretty good chart, even with today. Meta has pulled back, but it's still okay. So, today, S&P down 3%. We finished around 58.72. The NASDAQ composite down 3.6%. Mid caps, small caps, even worse. The small cap index is down about 4% today. The VIX, the only thing in the green, and it was up about 12 VIX points. We finished today just below 28. So if you've been following along at home, we are definitely above 15 at this point, right? We've definitely done it. So, and again, I don't want to minimize the importance of a day like today. This was a big down day, and I think one of the most concerning things we'll talk about in a minute is the fact that it was a 90% down day on the S&P 500. Some different ways to measure that, but basically 9 out of every 10 stocks were down today in the S&P 500. That usually is not a good sign, right? That usually doesn't happen during a healthy bullish phase when you got 9 out of 10 stocks in the red. We'll look at the chart of the VIX. We'll look at charts of the S&P here as we continue on with the show. 10-year yield and other interest rates moving higher. So what happened today is the short end of the curve has been brought down a little bit. As we've talked about, there's a normalization of the yield curve that is happening. The yield curve has really been flat here for a little while, and now it's starting to be more normal shaped. Bonds and stocks sold off today. So the TLT was down about 1.25%, which means the longer end of the curve with bond prices going down, the longer end of the curve is actually pushing higher. So the 10-year yield now around 4.5%. The long bond yield around just below 4.7%. So we literally have a normalization of the yield curve, and that steeper yield curve can eventually be good for certain things. But as we've talked about, one of the concerns I would have is when the yield curve becomes more normal, that's actually pretty bad for stocks in the short term. And maybe what we saw today is part of that, market recognition of the fact that the yield curve has been inverted. It is now normal and normal shaped, and that's usually not a good sign for stocks in the near term. One of the charts to think about would be the dollar. We actually had a question on this earlier this week. The dollar index pushing higher today, just about 1% on the UUP, but the dollar index is pushing up, and I think that's certainly a cause for concern here, because it's just echoes of 2022 are coming back to me here. Commodity space generally moving lower. Gold and silver prices both to the downside. The GLD finished down about 2%. Silver prices down 3.5%. Energy prices not as bad and kind of mixed, to be honest with you, but crude oil was down slightly. Cryptocurrencies all moving downward, sort of in complementing the downtrend in other risk assets. Bitcoin, noteworthy enough, still above 100,000. What's interesting on a day like today is traditionally what we would say is, the S&P rotating lower, but, market closes at 4 p.m. Eastern. So you kind of have to wait for the next morning to see if there's additional, sort of distribution. You can look at the Globex futures, right, 24-hour futures, to see what sort of after-hours movement there might be. But now we've got 24-hour markets with cryptocurrencies. And again, while not tied directly to risk assets, it'd be interesting to see what happens overnight with things like Bitcoin and Ether both down over 5% today, and most of that's happening sort of in line with the equity market trading session. So to be clear, not a great day for risk assets all around. All 11 of the S&P sectors were down today. Healthcare, consumer staples, utilities are your 3 best performing sectors. I think you probably know what I'm going to say about this. These are defensive sectors. One of the things we've talked about is when you are concerned about a potential market downturn, one of the check boxes on my market top checklist, which I'm sort of thinking to myself, I may want to dust off and share once again with my premium members, kind of update on where we're at. But as a reminder, one of those 7 check boxes is an improvement in the relative performance of defensive sectors. Because when everything starts to really go down in a big risk-off scenario, pretty much all the sectors go down. It's just which sectors go down a lot less. And this is where things like utilities, consumer staples start to improve on a relative basis. And the reason is because that's where institutions are rotating, and not enough to make them go up on absolute terms, but they really start to outperform. And as an institutional investor, if you're concerned about market downturns, that's where you tend to rotate, right? You have to own stocks. You can't cash out. You have to be invested. So you just invest in things that are lower beta, which means if the market goes down 2%, these are stocks and sectors that tend to go down a lot less than 2%. It's a really good way to outperform during a down tape, which is where a lot of active managers really benefit and are able to outperform quite well. So seeing those at the top of the list certainly echoes the distribution phase we're in here. The damage on the downside, consumer discretionary, which has been, by far the best sector here in the last 4 to 6 weeks. Post-election, it's been consumer discretionary up big, and everything else kind of okay to not good on a relative basis. And consumer discretionary leading the way lower, down 4.5% today. We'll look at some of the individual names in there for sure. Real estate number 2 down almost 4%. Technology number 3 down 3.2%. The problem with some of those sectors is that they represent a pretty big weight in the S&P, right? So the XLY, the XLK, two of the biggest sectors in the S&P in terms of weightings. And so if those things are done, if those things are down a lot, that's going to hurt the benchmarks for sure. Our market trend model, this is not quite updated, but the S&P's market trend model, at least today, did go below 0. So the short-term model, if the week ended today, if today was Friday, the short-term model would be bearish. We'll have to see what happens. And we'll talk about tomorrow and Friday. There's 2 more days left in this week, although it feels like the damage has certainly been done. Wanted to highlight over here, looking at advancers, decliners. And if you don't watch this on a day-to-day basis, I don't blame you. If you're a swing trader, if you're a short-term trader, I would be focusing a lot on short-term breadth indicators like this. If you're more longer term, I don't mind sort of looking at other indexes like the bullish percent indexes, and stocks above moving averages are more longer term breadth indicators to pay attention to. However, I always note when there's a big signal in the short term charts, because as I think we've mentioned, when you're thinking about short term versus long term, whatever that means, whatever long-term signal you might be waiting for, the short-term chart is where it happens first, right? When a market has been in an uptrend and then really starts to sell off, the hourly chart, the 15-minute chart are going to reflect instantaneously weakness in the market. The daily chart will start to pick up on that. If you have a series of hours, series of 15-minute periods that are really rough, then the daily chart starts to look bad. The weekly chart might still look good for a while, and then eventually will rotate lower. And so, it's often helpful to look at shorter term timeframes just to look for signs of concern. And 2 short-term indicators that I still pay very close attention to, even though I'm more of a long-term investor. Number 1 would be candle patterns. So if you see a bunch of like bearish engulfing patterns or hammer candles or things like that, that can, even though it's a short-term signal, that can maybe suggest that something is changing. And then it may be reflected in the longer-term timeframes. And also advanced decline data, and particularly looking at 90% up days and what we have today in 90% down day. Based on the data here on stock charts, the S&P 500, 96% of the S&P, that's almost the entire S&P 500, closed down today. And that is incredibly rare. I actually didn't save a chart of that, but I have one that I'll try to find here in a moment if I can remember. My mind's swimming just trying to make sense of this, as I'm sure for many of you the same way. It was sort of a scramble to try to gather the charts that I wanted to go through. All right, Magnificent Seven and friends, NVIDIA, the best of all of these, still down about 1%, but holding up the best. The problem is it's sort of pushing below that, the lower end of that range we talked about. 132 was the short-term support level we talked about. It broke down earlier this week, and today sort of further down. Apple down 2%. Everything else was down over 3% today. Tesla is still, up a ton, but down almost 10%. Ended up being about 8.25%. Amazon down almost 5% today. So, the real issue here, a lot of stocks have not been going up for a while, or certainly not been going up to the degree that we'd observed earlier. And that's been one of the key themes we've talked about, is the narrower and narrower leadership. The breadth has been getting rough for a while here. I've been putting a lot of content out about breadth deterioration, bullish percent indexes rotating lower, advanced decline lines breaking down. All of that speaks to the fact that it's sort of an unhealthy bullish phase, because the uptrend is being driven by a relatively small number of huge companies. But when this happens on a day like today, this is where this is the danger scenario. The doomsday scenario going into next year would be the mega cap names start to struggle. And what that means is what is going to propel the S&P or the NASDAQ higher if charts like Microsoft are down, 3 to 10% in a week. There's not enough names and not enough market cap in other areas of the market to keep the indexes strong. All right. If you like the color red, you're really going to enjoy this next slide here, which is the market carpet. And again, if you pick me up on being kind of happy, I try to have a good mood regardless of what happens in the market. Is one thing I try to separate portfolio performance with my general mood, because I will tell you, In an earlier part of my career at a Fidelity, where we're managing large amounts of money on a day like today, the amount of money that was exiting the firm's funds because of performance was too much. I mean, it was so hard to watch. And so you really had to learn how to disconnect the emotional reaction, which you don't want to do, to just the factual, let's gather evidence. Okay, today happened, what happened, right? Let's really try to quantify it. Let's try to have perspective and think about what it means relative to some of the long-term levels and signals that we've talked about. So on a day like today, what's your general impression? I mean, obviously a big distribution day and bright red. And I think a day like today shows you how some of the other days, which have felt like distribution days, really weren't that bad compared. Like, this is what a big down day would look like, where almost everything's down. All 11 sectors are showing quite a bit of stocks in the red. So that's where we're at. What did the largest names do? They went down a lot today, some less. And I think focusing on some of those stocks that did not go down as much could be helpful. Those could be some of the areas of the market that do better than average. If there's a protracted decline, if this is just the beginning, those could be some of the areas that do well. But certainly the largest names, I think that's the biggest change, is distribution days over the last 6 weeks. When we've had a down day, it's been the mega cap names okay, everything else kind of struggling, right? We've seen that a number of times on this particular moment in the show. The big difference today is that even the big names are down a lot. And I think, again, that's the biggest risk going into the beginning of next year. Some of those biggest names struggle. I don't think it's the end of the world for these names. I mean, I think these charts are probably going to be okay still through year end. That's what I would assume based on some of the traditional year end things that tend to happen. And charts like Meta and Alphabet are still the best charts in 2024. So as a portfolio manager, I'm probably still going to want to be there and have exposure to those stocks going into the end of the year. But this concerns me about what this implies for the beginning of January more than anything. Finally, outliers. And I would say particularly on a day like today, anything that's even kind of green, I would take note. I would write down those tickers. I would review those charts, because these are stocks that were up, even though the market got absolutely crushed. The problem is some of these charts are probably some of the worst charts that we've been seeing for quite some time. And biggest names that are up are all these healthcare names like UNH, CVS, Cigna, Humana, CNC, which is Centene. I mean, these have been some of the worst performers over the last quarter. McKesson may be one of the better ones, only because hasn't made a 52-week low in the last couple months. So it is a big mean reversion from charts that have been struggling that are up. SIBO, which is actually testing its November low and maybe finding support there, maybe that in like CME, same group. In the industrial sector, Boeing, I mean, Boeing really looks like a different chart than the rest of these. It's actually been in a downtrend and starting to rally off of the lows, but I don't find a lot to like in this particular heat map when I'm reviewing the conditions here. Yeah, and I see your comment, United Health green. Weird day doesn't begin to describe what a day like today actually means. All right, I meant to grab a breadth chart that I will show you here in a moment. I'm just going to get it queued up here. It's this one in particular, looking at advancers decliners. Yeah, all right, we'll save that, and I'll come to it in a moment if I can remember. All right. Let's look at the S&P 500 daily chart. So what's so interesting about a day like today is, even though the day was pretty bad, right? And this, of course, all happened in the last hour and a half of trading, really 2 hours of trading post Fed announcement. Certainly taking today's comments from Chair Powell as a big time negative. And again, this has been the risk to this market for quite some time, is a wake up call where great conditions aren't going to last forever. Maybe today's comments were part of that, kind of bringing expectations way down about the pace of rate cuts going into the beginning of the next year. But the S&P 500 holding 5850. We did close below the 50-day moving average. We have not yet broken the line in the sand. So what does that mean? I would say two things, right? Anytime you have a big down day, which it happens, right? These days happen. Look for the next day, right? And one of two things happens tomorrow, most likely, right? Number one, you have a big reversal day and you get a bunch of buyers coming in. Once we sleep on what happened today, wake up and say, you know what, things are still pretty good. It's going into year end. I think things are going to be okay for now. And we see a bunch of buyers come in that prevent a break of the line in the sand and maybe push us back above the 50-day moving average. And today feels like a weird aberration day as we get right back to normal. The other potential scenario, of course, is this is just the beginning. And again, 58.50 for me is the level to watch to determine which of those things is going to happen. As I promised, I'm not going to worry too much as long as we remain above 58.50. We're still above there. I'm not thrilled by what I saw today, certainly in terms of the amount that we saw things go down and the breadth of today's decline, particularly the downturn in the Magnificent Seven. I think that's the biggest concern here. And the fact that the RSI for the S&P 500 is below 40, which has not happened often. It's only happened two other times in 2024, the August low and the April low, and sort of right below, right going into those periods, not at the low, I should note, but, going into the lows is when you had the RSI get down to this point. So we're certainly in that sort of danger zone where this could turn into something much, much deeper. If we do push below 58.50, the subject of that day's show will be developing downside targets in the S&P or something along those lines. That's my working title, but we'll see. Market trend model, I don't formally update it until Friday's close. I do want to let you know that if today was the end of the week, the short-term model would be bearish. It's turned bearish 3 other times in 2024, which have basically been right around the major lows of this year, right around mid-April, late July, and late August, early September. Those have been the 3 most significant. Oh, that's not true. Actually, briefly there in October. I forgot about that one. Which was that pullback here. So the short-term model does tend to turn negative when you have a pullback phase. What separates a brief pullback from something more significant is things like the S&P break their line in the sand, things like the medium-term model turn bearish. That's really the main risk-off signal for me. That hasn't happened since September of 2023, which is when a brief pullback turned into a much more protracted decline, ended up being about a 3-4 month decline into the October low of last year. Maybe we see a similar sort of move here, but for now, short-term model could be turning negative. We'll have to see. I'll talk a little bit more about breadth here in a moment, but I do want to highlight that this is where things like Dow theory could end up being kind of helpful. What happened today was the equal-weighted S&P really accelerated the pullback that it's been experiencing really for the month of December. The equal-weighted S&P made a new high at the end of November, but since Thanksgiving, the equal-weighted S&P has actually been in a bit of a downturn, if not a free fall, while the S&P itself has held steady until today. So today's acceleration is really starting to push the equal-weighted S&P below its most recent swing low. I'm seeing today we actually broke below the October low. I'm looking at that similar level here on the NASDAQ, the equal-weighted NASDAQ 100. That's around 89, which means keeping an eye on that level to see if we get a confirmed break with both of those indexes could be a sign of further deterioration for sure. And I think the reason why that matters is because if this is breaking down, this is the equal-weighted NASDAQ 100. So this is really kind of the the overall market. As represented by the equal-weighted S&P members versus large cap growth, the equal-weighted NASDAQ 100. So if both of those are breaking down, that means the generals and the infantry are all starting to rotate lower. We had this chart on the show yesterday. I just want to highlight, just what's changed, right? So in one day, we can see that the indicators have not been particularly good. I mean, we highlighted this on the show, showing how conditions were actually kind of deteriorating. Today, obviously putting an exclamation point on that. So a couple of quick takeaways. And again, on a day like today, I'm sharing my initial reaction. I reserve the right to dig into these a lot further going into the next 24 hours. And some of the content I'll put on my YouTube channel will probably be a little more deep dives into some of these themes. But the advanced decline line in the New York Stock Exchange has already broken down and now continuing to make a lower swing low. We're almost at a new 3-month low on the advanced decline line. That's noteworthy. The percent of stocks above their 50-day moving average has actually plunged to below 25%. It's actually finished today around 20%. So a couple of weeks ago, end of November, 70% of the S&P above their 50-day, a full 50% of the S&P have now broken below their 50-day moving average, just as the S&P did today. What's interesting is at some point that actually becomes contrarian bullish, at least in the short term, when you get this low. And you can see it's only happened a couple times going back the last couple of years, kind of in this period, September, October of 23, and then back here in March of 23. The bullish percent index on the S&P 500 now below 50%, which does not happen that often, particularly in a bullish phase, but certainly looks similar conditions to sort of previous pullbacks and certainly previous periods of deterioration. The key with the bullish percent index is how long it remains below 50%. The longer it does, the less bullish it is. Let me switch into this chart really briefly, just to show you this bottom period, this bottom series is the percent of stocks down versus the total listings on the New York Stock Exchange. So around 92% based on this. And these are different numbers that we're aggregating here, but around 92% of the S&P, New York Stock Exchange listings look like they were down today. The last time that has happened was literally right at the August low. The difference is that had already been going down for a couple of weeks before we had that big plunge. This all of a sudden feels like an initial move lower. But again, it just doesn't happen that often, and it can be a sign of distribution coming up. Percent of stocks above their 50-day, this is the one we just looked at, down to 20%. The percent of stocks above their 200-day finished day around 55%, and that's really more of a concern for longer-term investors. Breaking below 50% does not, again, that's more of the long-term deterioration if stocks are not holding their 200-day. The S&P and the NASDAQ well above their own 200-day moving average. If that goes below 50%, I would say that's a pretty big sell signal, because that can often lead to much further of a downturn again, which we last saw in sort of that August, September, October period of 2023. This is a chart we highlighted on recent shows, stocks making new 52-week highs and new 52-week lows. This was one of the inputs kind of that triggered the Hindenburg moment, which we covered earlier this week, finally gave a confirmation on Tuesday. We covered that on yesterday's show. Pretty good timing with that one. I don't create the Hindenburg moments. That's not me. That's just the indicator triggering. But that's why I follow it, because it ends up finding conditions like we've observed before at major tops. And so now what do? You look for an expansion in new 52-week lows, right? A downtrend is usually marked by very few new 52-week highs and a lot more new 52-week lows. We haven't had a lot of red on this chart for quite some time. If that continues, that sort of puts further evidence on the distribution side for sure. Watch the dollar. We actually had a question on this earlier this week. It was a great question. Thank you to whoever asked that, because it sort of caused me to revisit that. The dollar index today spiking above 107. That's sort of that level we've talked about, that a break above 107 could be a danger sign. Go back to the end of 21 to the beginning of 2022, and we're probably going to dig into that a little bit further, because that analog for what we're seeing today could be very, very relevant. Early 2022, we saw the dollar just rally and everything else started to struggle. And that ended up being obviously a really painful year for investors. Let's keep an eye on this dollar spiking higher, which is a concern. Kip, I hear you, I see you, and thank you. Good question. Well done. I salute you, my friend. All right, the VIX obviously popping higher here. We talk a lot about levels on the VIX. And again, what I do to not go crazy trying to monitor every little flickering tick in something like the VIX is think about key levels. And that's why we highlight things like 15 or 16, levels like 20, levels like 28 or 29. We have now popped above 20. I am very much remembering my conversation with Tim Hayes of Ned Davis Research. He was the one that turned me on to some of these key levels. I'm pretty sure he was the one that told me about 28 or 29 as being the level. And in their back tests, when the VIX goes above 29, the forward-looking returns are usually pretty rough. Now, what's so interesting though is the last time that happened was in August, where the VIX got all the way to the 60s. Now, my interview with Russell Rhodes, I mentioned that earlier this week. I would encourage you to go back and listen to that podcast, because he particularly addressed that move, and he described something. I'll paraphrase what he said and then go listen to the full conversation, because I asked him about that moment, and he said it was a little unusual because it was really outside of the normal trading session that big spike happened. On a day-to-day basis, it wasn't as severe as the intraday chart would imply. However, I'm certainly watching the VIX here as we spike toward that green line, which is the in the research from Ned Davis that Tim Hayes shared with me Ooh, that was probably last year when I interviewed him. Suggested that was when forward-looking returns tend to be pretty rough. All right, we'll take a couple more charts. I'll see if any questions came in that we want to answer. I'm sure we're all kind of just trying to make sense of things, and as questions come up in the coming days, we'll continue to address them. Meta pulling back around 3.6%. I mean, I think what the biggest change that we observed here, besides the fact that just the indexes are down a lot, it's the biggest names struggling. That's something that we've not seen since the elections. The mega cap growth trade has been lights out strong. Today was not, and I think that's the biggest change. Meta back below this breakout level around 600. We talked about breaking out and holding a breakout level today now puts that into question. Let's wait for tomorrow to see if we were able to bounce back off of that support. And I would tell you, having done this a while, when you have a big down day like this, I would not be surprised if tomorrow's kind of a quick jump higher. That's pretty, because there's not a lot of news that's going to hit tomorrow. It's going to be digesting today. There'll be a bunch of people buying a short-term pullback like this. The question is what happens, kind of afterwards. And again, that's why we just seem to be so perfectly lining up for a painful Q1. And I hope that's not true, but boy, I'm seeing signs that make me feel that may be what we're going to see here. Microsoft down as well. And I think with Microsoft, it's similar to Meta, right? We had this resistance around 435 to 440. We did break above there in December. We're now back within there. Again, this is one day. So let's see if there's follow through, see if we're able to get back above 440 tomorrow. And if so, that wouldn't be as bad. But we're coming out of an overbought condition and now pulling back an initial move back within that breakout range. Today's drop does also pull NVIDIA back below that 132 level. That was the line in the sand we talked about there. So, again, a lot of things have been brewing. We've talked about things like the Hindenburg Omen, which really speak to the broader declines, but the strength in the mega cap growth trade has kept this market higher. This is what happens when the Magnificent Seven stocks start to pull back as well. And arguably, the market has been doing this for a while. It's just these biggest boxes have still been kind of green, and that's what's allowed the S&P and the NASDAQ to remain elevated despite some concerns underneath the hood. So, again, as we go on, I'll take a question or two. Keep in mind, as always, let's pay attention to key levels, key lines in the sand. S&P 5850 remains the level for me. We'll see what happens. All right, questions. Let's see. On YouTube, HA space R. I don't want to try to pronounce that. Hopper. I'm not sure. So I'm assuming it's like an acronym or something. But thank you for watching. What has changed? This looks like a great excuse to sell, pull back, and create some buffer space for a Santa Claus rally. So, and that's the key, right? I think what you have to remember, and thanks for asking about that. It's really hard on a day like today to separate the short-term pain of having a big down day versus the longer-term implications. This is why we have lines in the sand, and we don't just say, however you feel on a certain day, trade based on that. It's broader levels, right? And so I think looking at key levels on the VIX, did they break? Key levels on S&P or Meta, do they hold? Those are the questions I would be asking. I think the deterioration we've seen in breadth and momentum and volume suggests that days like today could become more common. But again, it's one day. So, again, the day after can be important. And again, I wouldn't be surprised if there's a bit of a bounce tomorrow that, if you look back at history when there's been a big drop, even if there ends up being a much further decline, day two is often a bit of a rally day. If we get a lot further distribution tomorrow, though, and if the Magnificent Seven push even further, that would be rough. Kip, you asked, let's see, I want to see what happened to high yield spreads today. Yeah, me too. So, again, if, when I used to work on a big institutional, money manager, we had a lot of short-term, intraday data on spreads, and we could track things very, very closely. With the data I'm able to access now as more of a retail investor, it's not as good and not as timely. So we'll have to see how high yield spreads emerge. I would not be surprised if spreads widen quite a bit today. The high yield spreads and the VIX tend to be very similar, and both of those popped pretty good. I didn't mention the MOVE index though, and I actually didn't include it, and that could be a bit of a hint as to what's going on here. But that I don't think is updated either. Boy, it's saying it's current. Who knows, right? I mean, this is saying the MOVE index is actually still pretty low. I would find that incredibly hard to believe if that's true, but there might be a delay with how this is reported. We'll see. We'll see what happens with it for sure. I would not be surprised if spreads have widened quite a bit here, but we'll have to see for sure. We'll take one more question, and then I do think we move for. We have to wait for the move. Richard, thanks for watching on YouTube. Dave, do you consider the Dow Jones Industrials in your analysis compared to the other indexes? Yeah, we've talked about it quite a bit recently. And if you watch some of my previous episodes, what has been happening, and this is why I love the fact that these are the three indexes that I like to track, and maybe small caps would be a fourth. If you look every day at the Dow, the S&P, the NASDAQ, and the Russell 2000 or the S&P 600, some small cap index, you're going to be able to understand pretty well leadership rotation. And if you don't have to watch it on an intraday basis, but look at those four charts, and if you look at the trends in those charts, what's happened is the Dow has been a lot weaker than the S&P, and the S&P has been a lot weaker than the NASDAQ because of that leadership, because the mega cap growth names have been so strong. That has been starting to shift a bit, and I think yesterday in particular we saw a bit of a difference there. Today, the Dow outperforming the S&P, which outperformed the NASDAQ. So it's starting to get a different flavor. And that's because of the sector leadership. When the defensive sectors and the value-oriented sectors are stronger, the Dow 30, the Dow Industrials are going to do better because it's just less weighted to growth and it's more weighted to other sectors. And again, more and more evidence, I think, is suggesting and if not confirming that going into next year, much more likely we get a leadership rotation. Maybe the Magnificent Seven are not as magnificent going into the new year. Maybe there's a new acronym we have to come up with some new charts. Challenge accepted. I will start to come up. We'll see what actually emerges in a position of strength, and I'll do my best to come up with a good acronym for that. Hey, folks, thanks so much for watching today. Trying to make sense of a distribution day like this. I would encourage you to follow data in the short term, but make short-term decisions with short-term data, make long-term decisions with long-term data. Let's see how some of the long-term charts are affected by this. Keep those lines in the sand and the alerts and levels in focus, and don't draw too much emotional reaction to a day like today. Gather the evidence and make a better decision tomorrow. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.